Hi everyone and welcome to this lecture. After learning how to set up your ads, in this lecture we are going to discuss how to read your ads results and how to analyze them. If you want to really optimize your business, understanding data is a key element. If you have a good understanding of data, it will be very easy to you to take your business to the next level. And it will also be very easy to know if you are profitable or not. I'm not sure if you have already tried running some ads, but whether you have tried it before or you are going to start now, analyzing Facebook data could look like a real nightmare. Facebook offers too much details, too many numbers, and they all seem weird and tough to you, especially if you don't like numbers and math was never your favorite thing. Well, don't worry, I'm here to hold your back. In this lecture, I will explain to you what are the most important metrics you should focus on in order to optimize your store. This will help you get rid of any frustration and will make dealing with Facebook data way easier. So let's start. Let's begin with the most important metric, the CPP, or the cost per purchase. If you remember well, we have talked about margin. Now we are going to call it the profit. So you have to compute the profit you are generating from acquiring a client to see how much you should spend on ads to acquire this client. If your client is paying you $2,000 for a consulting mission and you have to pay $1,200 for consultants working for you, it means your profit is $2,000 minus $1,200 equal to $800. So now, if you spend less than $800 on ads to acquire this client, it means you are profitable. If you spend more than $800 on ads, it means you are not. Same thing for a local business. If you are selling a yoga lessons membership in your town, you have to compute the average profit you generate from one client. Then you can know the amount of money you are ready to put on ads in order to acquire a client. For example, if your yoga membership is for $50 per month and you expect a client to stay 6 months on average, so you are generating $300 per client, but you still have other costs like electricity and rent. So putting $50 on ads to acquire one client could be a good budget. Again, every business is different and there is a lot of factors and calculations to do. And this is not the subject of this course, but you have to keep in mind the amount of money you are willing to put on ads to acquire your clients. Comparing your margin to your CPP is the most accurate indicator you can use to know if an ad is good or not. If your margin is $20 and your CPP is $8, well, that's great. You end up with $12 profit. If your margin is $100 and you already spent $30 on ad, that doesn't mean that your ad is not good. You are still able to spend more on ads in order to sell this $100 margin product. So if you end up with a sale after spending $75, which means your CPP is $75, it means you are left with $25 in the pocket, and that's great. But imagine that your margin is $12 and your CPP is $17. Well, that's very bad. You are losing money. Now, if your objective is to generate leads, you can apply the same logic. So let's say from your experience, if you have 100 qualified leads, you can generate $900 out of them. So your lead is worth $9 for you. So if you spend on a lead less than $9, you are profitable. If you spend more than $9, it means your campaign is not profitable. And this metric you use here is called CPL, or cost per lead. So if your cost per lead is less than the profit you are generating from each lead, then you are profitable. If you are not a data fan and you don't like to spend lots of time analyzing data, you can only use your CPP or your CPL, and they are sufficient to know if your campaign is doing good or not. But if you want to analyze your business more and if you want to boost it further, you need to look at more metrics, like the CTR, for example, which is equal to link click-through rate. It's the percentage of times people saw your ad and performed a link click. In other words, it's how many clicks you get when 100 persons see your ad. A lot of people ask me, which CTR is good? Well, the question is a little bit complicated because it depends a lot on your niche, on your product, on your ad copy, and on your audience. But as a general rule, a CTR less than 1% is not good. Again, if your CPP is good, then don't worry and don't kill the ad. When the CTR is less than 1%, it means in most of times that you should change your target audience or enhance your ad. Or it could mean that your product is not relevant. A CTR between 1% and 2% is considered good, but you should aim to do better. A CTR above 2% is considered very good, and a CTR above 5% is considered excellent. Another important metric is the CPM, or cost per 1,000 impressions. This is a metric that measures how much you are paying to reach 1,000 persons. Using this data, you can compare your ad sets. If one ad set is costing you much more than the others, you should figure out what to do, either to fix this ad set or to kill it. Again, even if your CPM is big, but if your CPP or your CPL is good, don't kill the ad. You should expect a higher CPM in the fourth quarter, especially in North America and Europe, because as you all know, at this time of the year, there are a lot of occasions where people buy products to gift them. Another important metric to consider is the ROAS, which stands for Return on Ad Spend, which is equal to the total sales divided by total ad spent. Let's see an example. If you spent $1,200 to advertise for a certain product and the sales were $3,600, then the ROAS is equal to $3,600 over $1,200 equal to 3, which means that every time you spend $1 on Facebook ads, you generate $3 in sales. But the ROAS is not sufficient to measure your success because this formula doesn't take into account your cost. So imagine that your cost is $2,500. You add to them the $1,200 ad spent, it gives you $3,700 cost for $3,600 in revenue. So it means that in this case you are not profitable. What you should do is to measure the ROI, which is the return on investment. Another important metric to consider is the ROAS, which stands for Return on Ad Spend, which is equal to the total sales divided by total ad spend. Let's see an example. If you spend $1,200 to advertise for a certain product and the sales were $3,600, then your ROAS is equal to 3,600 divided by 1,200, which is equal to 3. which means that every time you spend $1 on Facebook ads, you generated $3 on sales. But the ROAS is not sufficient to measure your success because this formula doesn't take into account the cost of your products. So, imagine that the products cost you $2,500. Add them to the $1,200 on ad spend, it gives you $3,700 as cost for $3,600 in revenue. It means in this case you are not profitable. What we should measure is the ROI, which is the return on investment. Your ROI is equal to sales minus cost divided by cost. If your ROI is positive, it means you are making money. If it's negative, it means you are losing money. So if you made $20,000 on sales and you have $5,000 as cost, it means that your ROI is equal to 3. It means that for every $1 spent, you made $3 profit. Now let me show you how to keep track of these metrics on your Facebook business account.